Just got back from a conference in Arizona, and one of the topics of conversation was from Art Laffer. He was Reagan's economic advisor. A lot of people credit him with a lot of the great growth that we experienced in the 1980s due to the Reagan tax cuts. Things I studied when I was in college was the Laffer curve, where he talked about what would happen to revenue when you reduce taxes. Well, he's off the charts optimistic about the future because of tax cuts and because of regulation reductions that Trump is actually talking about putting into place. And I actually got to talk to him a little bit about some of the things regarding Trump that might be talked about at a workshop sometime soon. What I want to talk about right now is Trump rallies and sell-offs. You know, the media, a lot of the media talked about a market sell-off that would occur with a Donald Trump election. Matter of fact, this one says right here, this is what could happen to the stock market if Donald Trump wins. What did they say? They said strategists agree that there would be a sell-off with a Trump win. But then there's views diverge on what the market would do after that. So basically the strategists are in agreement. It's going to be bad if Trump wins the election. And this one says right here, a huge hedge fund says stocks will crash if Donald Trump wins the election. They literally said this, said, first line, if Donald Trump wins the election, kiss your 401k goodbye. Well, I think a lot of people were more likely to kiss their 401k after the election because of how well the market actually did. There are people saying, well, it's going to crash. The market's been going, it's been so hot, it's going to go down at any point in time. My prediction is this. The market is going to fluctuate. It will. It always has. But let me give you a couple statistics that I think you might find interesting. Only once in the last 89 years has the S&P 500, or large U.S. stocks, not dropped at least 4.4% from an interim peak. It's fairly normal. There were 4 such occurrences in 2016 alone. But the market, of course, ended up, right? Now, if we look at it, 3 out of every 4 years, 3/4 of the time, these intra-year downturns were 10% or more. Pretty good size, really, when it gets down to it. 3/4 of the years, you have that big of a drop inside of a year. And the average was 17%. Pretty big downturn. Now, the point is this, expect it. And then when it happens, it won't be so scary. Expectations are critical. If I don't expect something like a market downturn to happen, when it does, it rattles me. It throws me off. And what a better time than right now when the market's doing okay for me to talk to you about this. Now, big moves are normal. So what are we doing from an investment perspective? What should we be doing? One of the things we're doing is we actually rebalance the portfolio inside the U.S., inside of international, inside of fixed income. They're rebalanced on a daily basis. Why? Well, one of the reasons is because we reduce risk with rebalancing. It's one of the key reasons that you rebalance a portfolio, is to manage the risk of the portfolio. When something gets a little bit overweighted in the portfolio, you either sell it off and buy the area that's underweighted, or better yet, have cash flows go to the area that's underweighted, and then that rebalances the portfolio. And they do it that way because it takes emotions out of the picture. Number 2, the other reason we do it that way is for tax purposes. When you rebalance based on cash flows, you're not selling something that's gained and then thereby creating a tax issue with that sale. And the other thing we do is trading costs. You know, if you think about it, every time I have to sell something to buy something else, it creates a trading cost. So in the management of the portfolio, number 1, we ignore the media predictions. They weren't so good at predicting who the winner of the election was going to be, nor what the stock market would do, and make sure that we take the emotions out of the investing process with the rebalancing process, and that makes for more successful investing. We'll catch you next time.